All right, today is Tuesday, April 27th. This is a recap for the stock market activities today. We continue to receive more and more corporate earnings. And after the bell today, we got very important earnings, specifically for the NASDAQ from names like Microsoft, Google, and AMD. All in all, the earnings are very impressive. These companies continue to deliver impressive earnings. The problem is the market has to decide what is already priced in the stock price and what's not. For example, after hours, you have Google and AMD blasting higher, at least during the time of the recording of this video. Meanwhile, you have Microsoft, which is a bigger name and a more important name in terms of weighting in the NASDAQ and the SPY, trading lower, even though the results were very impressive. And the reason is the stock ran too hot ahead of the print. Therefore, you're seeing a negative reaction for Microsoft, not so much for Google. Now, the market will make a definitive decision after processing all of these earnings. Do these earnings, and most importantly, the outlook for these companies, justify another run higher? Or did the earnings for these companies already peaked, and perhaps the best of the gains is already behind us, and therefore we will see a sell-off? We have the big kahuna, the most important name, the most important stock in the world, reporting tomorrow. And that is Apple. The market could continue this choppy trading for another day or so, but once we receive Apple's earnings, I believe that the market will have more clarity on the next move. The technicals are looking very extended, yet all in all, the selling appetite is not here. Nobody wants to sell, and therefore the risk is that the selling will come by force. Perhaps there is a catalyst that will force an algorithmic selling in the stock market. And that could be, by the way, tomorrow's FOMC meeting from the Federal Reserve. We know that Chairman Jerome Powell is very stubborn and he is sticking to the playbook that inflation has a long way to go, and he will continue to keep the easy policy because it is needed to continue this economic recovery, quote unquote recovery. So we are not expecting any surprises regarding decisions from the Federal Reserve. However, and this is the important take, the market wants a pulse regarding the upcoming tapering. We know that the Federal Reserve will taper. The question is when. I do have an interview that Jerome Powell did recently with Rubenstein. And in that interview, Jerome Powell says something very important. And of course, during the press conference, perhaps the FOMC meetings, the minutes, they're not going to say anything about tapering. But during the press conference, perhaps Mr. Powell will be asked regarding the upcoming tapering, and he could slip and say something that the market doesn't want to hear. I have all the information that you need, and I'll cover them during the headlines of the day segment. But for now, let's start by covering the market's performance today. And here we go. The Dow Industrial Average closing pretty much flat, but slightly in the green by about 3.36 points or 0.01% gains. The Nasdaq closing in the red, down 48.56 points or a decline of 0.34%. The S&P 500 on the flat line, down 0.90 points or a decline of 0.02%. What about the sector's performances today? Leading the pack at number 1 in capturing the gold medal, industrials, and number 2 for the silver, financials, and number 3 for the bronze, energy. Meanwhile, the laggards of the day led by utilities, materials, and healthcare. All in all, the cyclical trade, the inflationary trade is outperforming today. What about the advance to decline ratio for the New York Stock Exchange? 50% advancing versus 48% declining, no definitive conclusion here. Meanwhile, for the Nasdaq, the weakness is evident. 58% declining versus 39% advancing. Moving on to the futures market. Crude oil closing with gains today of about 2% apiece for both the WTI and the Brent crude oil. But the notable gainer here, ethanol futures, and the inflation in corn prices is starting to show up in the form of ethanol prices. Likewise, what about softs? Massive gains for sugar, cotton, coffee. Meanwhile, we saw OJ, lumber, and coca pretty much flat with slight losses for coca and lumber futures. I had a trade for sugar futures. I have already closed that one with double-digit gains, yet the trajectory for sugar futures remains higher. Likewise, it's a similar story for cotton futures. I'm still in those. I haven't closed my contracts yet, and I see more gains for cotton futures. So even your underwear is going to start costing you a lot more. You better keep them clean. Don't shit your pants when you see a market sell-off. What about metals? Gains led by palladium, copper, silver, all closing in the green. Meanwhile, slight losses for gold futures, and the notable decliner today was platinum futures, down about 1% or so. What about meats? Lean hogs, gains of about half a percentage point. Meanwhile, declines for both live and feeder cattle, the declines led by feeder cattle futures. What about grains? The tear, the rally that's been going on since last year in corn futures continues to go on and on and on every single day. The trajectory for corn futures also remains higher. We also saw sizable gains for soybean oil futures and canola futures. Meanwhile, declines led by soybean, wheat, soybean meal, rough rice, and oats futures. Moving on to the big casino, the options market, and the volume is just dead. There is no action whatsoever going on in the casino. What's going on, folks? Can we get some action here? The market is very boring. What happened to the days of diamond hands and GameStop popping higher and all of those gamma squeezes and short squeezes? What happened? Where did the retail crowd go? That is the $1 million question. Did they get slaughtered, or did they just decide to get out of the market because it's not fun anymore? You know, stocks are not riding higher 10% every day like they used to last year. But anyhow, we still have some action worthy of covering in the options market. And here it is. Number one, not Apple. The most traded options today came from Ford stock. With a little over 650,000 contracts traded today, only about 15% of those were calls. So the majority of bets were against Ford for some reason. Next, we have AMD reported earnings after the bell, and the name is riding higher the last time I checked. And today we saw over 565,000 contracts traded for the name. About 72% of those were calls. So in this case, they got it right. What about Apple at number 3? Dropping significantly. The volume used to be over 1 million contracts for Apple pretty much every single day. Yet the volume is drying as of late, at least this week, and so far today we saw about 560,000 contracts traded for Apple. About 64.5% of those were calls. Apple will report earnings tomorrow. And by the way, this is a bad sign. The lack of confidence of buying call options prior to earnings. We saw that with Tesla. Usually we see elevated volume prior to earnings before these stocks pop higher. This wasn't the case for Tesla this week, and now it is not the case for Apple. The other notable take from the options market today is the reversal of the mania names today. Yesterday, we saw elevated call buying for the mania names, the likes of CCIV, NEO, Plug Power, etc. What do you know? That was just a pump and dump, and these names are reversing lower today. Yesterday, we saw retreat for yields, getting rejected from 1.6%. Today, we saw yields bouncing higher with a lot of strength and recapturing 1.6 and climbing higher. We will cover the chart of the 10-year Treasury yield during the technical analysis. But again, the rise in yields is defeating any hopes for a relief rally in these names. And therefore, you gotta be extremely careful here of chasing the pops and the mania names. Yesterday was Microvision popping higher. Today, the name is down double digits. So you gotta be careful here because there are a lot of games being played in this options market. Pumping certain names for a day or two only to dump them right away. Yesterday it was Microvision. Today it's Vaxcart. What do you know? The next day they dump it again. You gotta be extremely careful here and extremely disciplined. Moving on to the unusual trades that took place in the options market today, starting with, here it is, Vaxart, the ticker VXRT. The name popped higher today for whatever reason, and now they're betting on more gains to come. But you gotta be really careful. The pumps and dumps are all over the place, and they're happening very short term. Anyhow, in this case, they're buying the $9 calls expiration date April 30th, meaning this upcoming Friday, with expectations that the name will rise over 11% by then. They paid about 70 cents a piece to enter this trade, all in all bringing the total to about $1.2 million. What about the trade for the ticker SPCE? This is for Virgin Galactic, a company with no revenue, but the bros kept telling me that it is the future, bro. It's the future. What do you know? Their cult leader Shamath Predatoria preyed on them and dumped the name, taking a nice warm dump on the top of their heads. And then that was followed up by Sir Richard Branson taking another massive dump, followed by Cathie Wood taking another massive dump, liquidating half of her position in the so-called space ETF. But perhaps the selling forces are over now, at least from looking at this bet, because they're buying the 27 calls expiration date May 7th, with expectations that the name will rise over 15.5% by then. They paid about 80 cents a piece to enter this trade, all in all bringing the total to about $1.2 million. What about the ticker SONY for Sony? They're making a bullish bet here by buying the 114 calls expiration date May 21st, with expectations that Sony will rise over 6% by then. They paid about $1.50 a piece to enter this trade. All in all, the total bet for this trade was $1.6 million. What about the ticker ATVI for Activision? They're making a bearish bet this time around by buying the 86.5 puts expiration date May 7th, with expectations that the name will drop over 5.5% by then, and the trade cost them about $1 a piece, all in all bringing the total to about $1 million. What about the ticker ARKKKKKK for Tesla Witch Cathie Wood's ETF? They're making a bearish bet on this one by buying the 114 puts expiration date May 21st, with expectations that the name will drop over 10% by then. They paid about $1.85 a piece to enter this trade, all in all bringing the total to about $900,000. What about the trade for the ticker KSU? This is for Kansas City Southern. The name jumped higher based on M&A news, and the earnings were also impressive. But somebody's calling a top here for the name by buying the 285 puts expiration date May 21st, with expectations that the name will drop over 5% by then. They paid about $3.50 a piece to enter this trade, all in all bringing the total to about $1.75 million. Lastly, what about the ticker BYND? We have two of those, so pay attention here for both of these trades. For the ticker BYND for Beyond Meat, this is what it's called a strangle trade. Basically, you're expecting a massive move one way or the other. However, you're leaning toward one side of the trade, and in this case they're leaning toward the bullish side because they bought the 140 calls in addition to buying the 120 puts. Now the stock is trading at around 133, meaning it is closer to the call, not the put strike price. So the trader is saying, I expect Beyond Meat to blast higher after earnings or whatever event it is over $140 a share. However, I'm also interested in buying protection in case the move after earnings surprises to the downside. And therefore, they're buying the 140 calls in addition to the 120 puts for the same expiration date of May 28th. And they paid about $6.50 a piece to buy the 140 calls. They also paid $4 a piece to buy the 120 puts. All in all, the entry cost for this trade was $10.50 a piece. And that brought the total all the way to about $5 million. Now, the problem with Beyond Meat is that perhaps we will see some liquidation of positions in Beyond Meat to buy the upcoming IPO of Impossible Meats. So that is one thing traders and investors have to keep in mind. Moving on to the headlines that shaped the day, starting with macro news. Let's start with this interview between Jerome Powell and Rubenstein, his former boss, by the way. Of course, Papa Jerome is not going to do interviews with the Fed critics. They have these events that they call the Fed Listens. Or it listens, huh? If it listens, then Jerome Powell should do interviews with Federal Reserve critics. And many of them extended interview requests to the Federal Reserve, and they haven't heard back. Meanwhile, Rubenstein gets Jerome Powell on demand, and he gets to ask him the softball questions. But all in all, Rubenstein asked the most important questions that we need to know. And we can read through the bullshit of Jerome Powell easily. Now, why is this interview important? Because we have the FOMC meeting tomorrow. Once again, I do not expect a decision, whether it is regarding interest rates or even tapering, to come out tomorrow. But the guidance, once again, the outlook, is the most important thing to watch here. The market will listen to Jerome Powell and the minutes and will try to interpret when will tapering happen. Perhaps we'll have a clue from this interview. Here it is.
Let me begin by talking about the state of the economy. Your public statements to date and recent interviews makes it sound like you feel the economy is in reasonable shape to go forward from here, and you're expecting growth of 5 to 6% this year. Is that a correct announcement of your views?
Generally, yes. I would say that the economy at this point does seem to be at a bit of an inflection point, and that makes sense with ever more widespread vaccinations, with strong fiscal policy, with continued support for monetary policy. You see the economy opening. You can see ridership on airplanes going up and people going back to restaurants. I think the March jobs report that we recently got shows what that can look like, which was close to 1 million jobs in a month. So I think we're going into a period of faster growth and higher job creation, and that's a good thing.
Now, listen carefully, because he attributes the economic recovery and people going out to restaurants, hopping on planes, and the rehiring in the economy due to the monetary policy of flooding the system with cash, the liquidity, the cocaine operation of bond purchasing, etc. And by the way, all of that goes to where? Big corporations and the rich. It does not go to small businesses, mom and pops, etc. In essence, Powell is saying that all of this recovery that you're seeing in the jobs market and consumer behavior is partially, if not mainly, due to the monetary policy. We have to keep our foot on the pedal, meaning the Federal Reserve, to continue to see more positive results. The problem is that this man is delusional. He is in denial. The monetary policy has nothing to do with the jobs recovered or with the consumer behavior feeling more comfortable of going out to eat, spending in small businesses, hopping on planes, making travel plans. This has nothing to do with the monetary policy. It has to do with the vaccination progress and the diminished number of infections. No business out there is saying let's hire employees and reopen again because Papa Jerome is buying more bonds. They're opening, hiring employees, and the customers going out to eat and spend at these businesses because they're vaccinated, the virus is going away, and they're feeling more comfortable to resume consumption in the economy, leading employers to hire more people and recover these jobs that we lost to begin with due to the COVID-19 virus. Keep that in mind.
I would point out there's still risks. In particular, I would say the main risk is that we'll have another spike in cases, perhaps in one of the virus strains that may be more difficult to treat. Now, we don't see that yet. We do see cases having moved up a bit, but that's something we need to be careful about, and I think we'd be wise to keep wearing masks and being socially distant at least for a while longer.
Okay, here comes the bullshit from Papa Jerome. Now he says, we gotta be careful of new variants, we have to continue to wear masks, etc., etc. Why are you worried about new variants of the virus when all what matters is the monetary policy, the cocaine operation? First, you say that the monetary policy is contributing to the economic recovery. So what do we care about new variant or the virus? Because all what matters is the monetary policy, right, Mr. Jerome Powell? This is the garbage, the bullshit that comes from the Federal Reserve. The monetary policy has a minimal impact of recovering all of these jobs, or reclaiming and recovering these jobs because the virus is in control and the virus for now is going away. The monetary policy is only contributing to increasing inflation. Ask yourself a question. Did the hotel in your town reopen hiring more people now because, oh, Jerome Powell is buying more bonds? Or are they reopening and hiring more people because the customer, the consumer, feels more safe after being vaccinated and by looking at the downward trend in the number of new infections? Continuing.
The debt is pretty high, 27 trillion or so, and the annual deficit is now about 2.5 to 3 trillion or so. Is that a concern to the Fed in terms of impacting inflation?
So yes, in the over time and in the longer run, the U.S. federal budget is on an unsustainable path, meaning simply that the debt is growing meaningfully faster than the economy, and that's by definition unsustainable over time. It's a different thing to say that the current level of the debt is unsustainable. It's not. The current level of the debt is very sustainable, and there's no question of our ability to service and issue that debt.
Oh, really, Jerome? There's no question that it can service the debt? By what? By printing more money to pay up for the money we printed before? If that is the case, then why is the government running high budget deficits in the tune of trillions and trillions of dollars and now resorting to raising taxes to reduce that budget deficit? The level of debt is not sustainable, and servicing the debt is indeed an issue and a cause for concern
for the foreseeable future. I would also say, though, that as a nation, we will have to eventually get back to a sustainable path. That is something that is best done in very good times, when the economy is at full employment and when taxes are rolling in. This is not the time to prioritize that concern, but it is nonetheless an important concern that I believe we will ultimately have to return to again when the economy is strong.
Okay, he says that we should get back to a sustainable path once again, meaning tightening the monetary policy, not running high budget deficits, but that should take place when the economy is very hot and able to absorb the negative consequences of tightening the monetary policy. You mean like right now, Mr. Powell? Because here it is. This is the outlook from Goldman Sachs regarding the GDP growth. They are saying that the GDP growth will peak during this quarter, the second quarter of 2021, and then the growth will moderate all the way till next year. So isn't it time right now, when things are really hot? The last jobs report showed that we have gained over 1 million jobs in a single month, meaning that the economy is extremely hot, and perhaps indeed it is in a peak. Isn't it time right now to start tapering when the economy and the stock market is able to absorb the negative consequences from tapering? The market is in a mood of shaking off any bad news. If you start tapering now, just slightly, perhaps the market will go down 10, 20%, or even shaking it off altogether. But even if it goes 10 to 20% down, it is better that we take the hit now rather than later, because you're going to be forced to taper at some point, and when that happens, perhaps the economy is not going to be as hot as it is right now, and the market's ability for absorbing the shock from tapering will diminish.
Now, you have previously said, I just want to ask you if you feel the same way now, that currently you do not expect the Federal Reserve to increase interest rates before the end of 2022. Is that a correct view of what you've said?
So here's what we've said. We've said that we would expect to keep interest rates where they are today until three particular outcomes are achieved in the economy. The first is that the recovery in the labor market is effectively complete.
Okay, what does that mean? The recovery in the jobs market is complete. What does that mean? What does complete mean? Does it mean 4% unemployment rate, 3%, 2%? What is the threshold here? The Federal Reserve will not give us any guidance. Just like when they talk about inflation averaging 2%, but they say we're not guided by any formula. We're just going to eyeball inflation. And Jerome is being vague here. What does complete mean? And if you dig and ask him more, he will talk about minorities and disadvantaged groups, which, by the way, continuing on the same monetary policy of buying bonds, the cocaine operation, keeping interest rates low, that will only achieve higher inflation and weaken the US dollar. But it is not a guarantee that doing this practice, this policy, will effectively recover jobs. Because reason number one, companies have discovered that they can do more with less during the pandemic. Certain companies need not to expand employment. Furthermore, employees, as I showed you during last night's video, and other videos previously, have a lot of choices now. They're getting paid unemployment benefits. We're pretty much going to have a UBI coming. We already have UBIs in certain cities in America. The new generation is discovering other outlets to make money, from the gig economy to doing Twitch and OnlyFans and Robinhood, etc. So what is the threshold? What is the framework of the quote-unquote complete recovery in the jobs market? What does that even mean without a guidance and a clear framework? For all you know, this will mean to infinity and beyond. The Fed will continue to do the same policy over and over and over again. We will not recover the unemployment rate completely. Meanwhile, continuing in this policy with the foot with full force on the pedal will create inflation. Meanwhile, unemployment could remain high. There are no guarantees that employment will recover from this policy or that the jobs created from this policy will be sustainable, meaning this is once again paving the way for the possibility of stagflation.
The second is that inflation has reached 2%. And really reached it, not just sort of tapped the base, as I like to say, but has reached it sustainably. And the third thing is that inflation is on track to run moderately above 2% for some time. Those are the tests. So we are really focused on the progress of the economy toward those goals and not on a particular time frame. When we get those three boxes checked, that's when we'll consider raising interest rates, and that's when we'll raise interest rates.
Okay, but based on what you know to date, you would not expect to increase interest rates before 2022, or you're just not saying that yet?
Well, before 2022, that would be this year. I think that would be highly unlikely. I don't talk about particular dates. I don't think there's any use in that. So, but it really is outcome based.
Are you paying attention or not? He just said that raising interest rates will be quote-unquote outcome-based. He continues to say that we're not thinking about raising interest rates. But now he's saying it is outcome-based. What does that mean? It means if inflation runs hotter sooner than the Federal Reserve is anticipating, that will mean that the Federal Reserve will also start raising interest rates before anybody, including the Fed, is anticipating. And do you think that Jerome Powell is going to announce that to us in advance? Jerome keeps saying, continue to gamble in the stock market. Don't worry about anything at all. I got your back. When I am ready to taper and raise interest rates, I will let you guys know in advance. Or really? Are you going to let me know in advance? Or are you going to let Rubenstein know in advance? Because for all we know, he's dumping hundreds of millions of dollars worth of his stocks. You cannot trust this guy at all. They keep saying, don't fight the Fed. This time around, fight the Fed because they're lying to you.
Well, let me ask you, last time the Fed did increase interest rates, it did so by a little bit, and then it started shrinking its balance sheet a bit. Do you have any view on whether that's the right way to proceed when you begin to increase interest rates? Should you increase interest rates and then shrink the balance sheet later, or should you begin to shrink the balance sheet and then increase interest rates? Do you have any view on whether one policy or the other is better?
So what we did after the global financial crisis was first we were buying assets, and then we gradually slowed the pace at which we were buying treasuries and mortgage-backed securities, and then we held the balance sheet constant for a while. After that, we started raising interest rates. We raised them gradually, and at some point we held the balance sheet constant. So we don't sell bonds into the market, and we either, when they mature, we either reinvestment or that we allow them to run off. So that's what we did last time. I think if you look at the sense of our guidance, it is that we will reach the time at which we will taper asset purchases when we've made substantial further progress toward our goals from last December when we announced that guidance, and that would in all likelihood be well before the time we consider raising interest rates. We haven't voted on that order, but that is the sense of the guidance, is that it would work in that way.
Now he is admitting that the tapering will happen well in advance before raising interest rates. But remember what he said before. Raising interest rates will be outcome-based, meaning that if inflation gets out of hand rapidly and quickly, you could see the tapering and raising interest rates happening back-to-back sooner than anybody is anticipating. And that will be a disastrous outcome for the stock market.
When you come to work sometimes, you see people in tents, living in tents, homeless people living in tents. Your mandate is not to go solve that problem necessarily, but Is there anything you think the Fed should be able to do or should be given more power to do to help people who are really suffering in the pandemic?
We're definitely not seeking any new authority, nor are we, as I mentioned earlier, we're not the agency that has the most direct authority over that. I just happen to see it, though, right here on Virginia Avenue. There have often been a couple of tents where at this end of town where there's some open space, but now it's big. It's a lot of tents and it's a lot of people, and you can't miss it. You drive by and you think, and it has to be because of the pandemic. It just has grown a great deal, and it really struck me it strikes me every day as I go by it. So, how does that play into what the Fed does? I think we need to keep those people in mind, really. We don't have tools that deal directly with them, but those are people, many of them probably were working in February of 2020 before the pandemic hit. And I think they need to be in the room with us as we make our decisions about monetary policy. We need to be thinking that it's not just the headline in the aggregate, it's also the people who are at the margins of the economy. We just keep them in mind.
Oh yeah, let's keep these poor bums in mind, because we in the Federal Reserve did not have anything to do at all with creating the homelessness problem, right? Bullshit. All of this policy of printing money out of thin air, flooding the system with liquidity, and that liquidity magically floats to the 1% and corporate America that is inflating stock prices and real estate prices, where housing is becoming unattainable for the majority of American households. Rents are going higher. And the moment you lose your job and you're not able to pay your rent, you are at the risk of being homeless. For now, we have the evictions moratorium, but once that expires, we're going to have a homelessness crisis, meaning that the evictions moratorium has to stay pretty much forever. And now it's staying to the point where landlords are now asking for a handout from the federal government because they cannot evict the tenants who are not paying, and the bills have been racking up for month on month now. It is pretty much impossible for the tenants to pay all of what they owe, meaning that the landlords will depend on federal aid to compensate for their losses. Ask yourself a question: is this a sustainable system or what? Furthermore, today we got important data regarding the housing market, and Jerome Powell keeps saying the 2% target, the Fed inflation is 2%. We're not at 2% yet. We need to stay above 2% for a while to average 2%. Here's the data we got from the Chiller Home Index today. Pretty much every single major metro area in the United States, the home inflation is way above the 2% target of the Federal Reserve. Take a look, for example, at Phoenix, Arizona. The inflation year over year in homes prices reaching almost 18%. San Diego over 15%, the home price inflation year over year. So what are you talking about, Jerome? Are you even paying attention to this data at the Federal Reserve? Are you guys even paying attention of real inflation? Or are you guys just relying on the CP Live formula? Here is more regarding the housing market. U.S. home prices rise at the fastest pace in 15 years. The S&P CoreLogic National Price Index rose 12% year over year in February. The 10-city composite rose 11.7 annually, 11.7% that is. The 20-city composite index jumped 11.9% year over year. But hey, where is inflation, right? And by the way, this so-called recovery, it's pretty much a zombified economy hooked on steroids, on the cocaine. And once that cocaine goes away, you will see the truth about this recovery. All of what they're going to achieve is sustained, persistent inflation, and the recovery in the jobs market. There are no guarantees that that will be persistent as well. And therefore, once again, paving the way for the stagflation phenomena. If you're asking, where is inflation? Here it is, for everyday goods that you and I consume. What about toilet paper? I'm assuming that you people use toilet paper, and if you do, you're going to notice the increase in prices because Kimberly-Clark and Procter & Gamble already mentioned the inflation in toilet paper prices, and in return, they will increase prices and pass them down to us. So you know those long receipts that you get from CVS? You might want to keep those even if the coupons expire. What about soft drinks? We already heard from Coca-Cola saying that they will indeed increase prices. Peanut butter, J.M. Smucker, also increasing the prices of peanut butter. What about breakfast cereal? General Mills also increasing the prices of cereal. And by the way, these defensive companies, General Mills, J.M. Smucker, Coca-Cola. These are the names that have the ability to pass the extra input cost to the end customer, and therefore they withstand the inflationary pressure better than a lot of names in the stock market. What about coffee? They're coming for our coffee. Here it is. James Smucker, Dunkin' Donuts, even Starbucks, which reported after the bell today, announcing that they will increase coffee prices. And the reason is, take a look at the chart for coffee futures. Month to date, we're talking about 1 month. Coffee futures rose over 20%. Yesterday alone, over 3.5%. So we're seeing an explosive movement in coffee futures, and that will indeed translate into higher prices for us consumers. What about feminine hygiene products? Procter & Gamble also mentioned raising prices for these products. What about steel? Look at the chart for steel. Unbelievable move higher. Where is inflation? It's right here. You just have to take your blindfolds off. What about agricultural commodities, specifically corn, also reaching multi-year highs? You saw the rise of copper. Copper is trading almost at all-time highs. And now we have a problem with shipping containers. There is a shortage of shipping containers, and that is also adding to the pain on consumers because prices across the board will rise higher. The loss of containers reached the highest level in 7 years. And by the way, what are the impacts of lost containers and the shortage in these shipping containers? How about the shortage in rubber?
First, it was toilet paper, then it was grape nuts, now it's computer chips and rubber. Multiple factors are leading to a major rubber shortage around the world. Seema Modi is here with the details on how that's impacting us all across the U.S. Seema?
Kelly, the shortage of raw materials, as you said, first it was paper, plastic, and now we're hearing that rubber is increasingly hard to import for some industries. So what's the problem here? Well, it's multiple factors. A lack of shipping containers, bottleneck caused by the Suez Canal, and a recent surge in demand from end users. Most of the world's natural rubber comes from Southeast Asia, Thailand specifically, the largest producer, 15,000 miles away. And due to the shipping delays, some businesses are now using other modes of transportation to import the rubber they need.
And now we have people like Jeffrey Gundlach, also known as the Bond King, at least formerly, but for sure now known as the Kleenex King because he keeps crying and bitching and moaning on Twitter about pretty much every single thing. I don't know if that's due to aging or midlife crisis, but anyhow, the man is very smart and his outlook and take on things is extremely important. And now he's saying that this whole transitory bullshit is pretty much based on central bank guessing. They have no framework. They're just going to eyeball inflation. They have no guarantees that inflation will be transitory, and this is a very, very risky game. Furthermore, we got information from the Dallas Fed. Their outlook for the prices of finished goods also surging to multi-decades high. And by the way, the correlation once again between the outlook prices of finished goods and the core CPI is extremely accurate, meaning if the outlook prices of finished goods is exploding higher, it is just a matter of time before the CPI also starts exploding higher. We know about the cooking that's going on with the Bureau of Labor Statistics and the censoring of data, etc., etc. But they cannot keep the truth hidden for too long. What about the outlook for wages and benefits? Also reaching the highest levels since 2006, meaning the wage inflation is coming. And indeed, the Dallas Fed is saying our Human Resources Department reports that even at a starting pay for non-skilled level workers of $14 an hour, we cannot fill our 20+ open positions, meaning that if you thought the minimum wage of $15 is bad, think again, because if we rely on fair market value, the minimum wage will go up to at least $20 an hour. Employees, at least here in California, they're not going to take a job paying $15 an hour. It's not worth it at all, given the level of benefits from the federal government, state, and local. You got to pay at least $20 an hour to incentivize workers to take the job. And here it is for non-metallic mineral product manufacturing, according to the Dallas Federal Reserve. It is very difficult to find employees to handle the significantly increased demand. We have never had this problem before in our 44-year history. Furthermore, we are experiencing rapid increases in the price of steel, lumber, and cement. This is increasing costs of production and will lead to higher prices eventually. We're also having shortages at various times in getting these materials. And the mania is spreading everywhere now, because every commodity out there is at elevated prices. So when you spot a deal, for example, uranium, which is, or at least was, trading at cheaper levels, now even uranium becomes a vehicle for storing value and speculation, leading uranium prices higher and higher. And by the way, is there any stopping sign here for the consumption and the level of demand? At least not for now, because we also got the Consumer Confidence Index, and here it is. U.S. April Consumer Confidence Index rises to 121.7 from 109. Present situation read at 139.6. So the consumer is highly confident to go out and spend even more. So there is no stop in sight for the demand side of this inflation. And by the way, Jerome Powell and the Federal Reserve continue to tout their policies and credit these policies for the quote-unquote economic recovery. And we know that this is a K-shaped recovery, and that could not be more evident than the contrast between corporate America doing extremely well, as you're seeing from corporate earnings, and small businesses, mom and pops. Mom and pops are getting destroyed. Meanwhile, corporate America is swimming in cash. They have more cash than to know what to do with, and therefore they're accelerating shares buybacks. Moving on to sentiment news, let's start with this chart. The CCC spread. This is for the garbage bonds, and the spread is reaching a level only seen 2 times in recent history. Number one, preceding the crash of 2008-2009, and the other time is preceding the dot-com bubble crash. Don't say that the warning signals were not there. And by the way, what does that mean? It means that during a bubble, investors are highly confident that buying the CCC bonds is highly rewarding. Number one, you capture the higher yield that you cannot get anywhere else. Number two, you ride the ride higher when the bond prices for these garbage bonds increase higher and higher and higher due to the tsunami of liquidity coming out of the Federal Reserve that emboldens market participants to take more risks. But that reaches a level of extremes where things start to reverse. If history is accurate, then we have reached this extreme level from which the market will start to turn around. Furthermore, we have other indicators. For example, the risk premium. You see all of these spikes higher? This is the time when you want to buy the stock market. This is the time when the risk is worth it. But when the risk premium starts to collapse, this is not a buying opportunity. This is a seller's market because the risk versus reward is not worth it anymore. Here is another sentiment indicator that is very important and highly accurate. When the margin debt growth reaches above 50% year over year, that is usually an indicator that the market is highly bloated in an extreme bubble territory and the pop is imminent. And that is, by the way, only happened twice in recent history. Number one, the dot-com bubble bust, and prior to the financial crisis, the crash of 2008 and 2009. What a great company to be with. Once again, don't say that you haven't been warned. But hey, rest assured, Jim Cramer of CNBC, you know that Jim Cramer who said buy Bear Stearns the day before it collapsed. This is the same guy also saying that the market hasn't peaked and we are actually starting a new cycle in the economy. Jim Cramer says, put your blindfold on and buy. But you know who doesn't have your back? It is Reverend Elon Musk, because he's starting to stab the culties in the back, specifically when it comes to the 21st century's tulip mania of Bitcoin. First of all, Reverend Elon Musk is a master of the art of deception. He quote-unquote accidentally made a mistake and charged his customers twice for the vehicles they purchased this quarter. He also made a quote-unquote mistake of overcharging homeowners for the solar panels. And it also happens to be a coincidence that he bought Bitcoin before the start of the quarter, pump it higher, only to dump it again and cash in the amount needed to make this quarter of Tesla profitable. He also magically, coincidentally of course, decided to raise the prices for the Model 3 and Model Y this quarter. All in all, when you look at the results for Tesla, it was an impressive quarter. But the devil is in the details. This company remains unprofitable from their core business, selling cars. They do not make money from selling cars. And now, of course, the Bitcoin culties, the cryptomaniacs, are now questioning Elon Musk. Why did you dump some of your Bitcoin holdings? Paper hands, what happened to holding Bitcoin for the long term? Of course, Elon has no loyalty to anything. He's a pumper and dumper. And he is justifying dumping some of his Bitcoin holdings to prove liquidity as a cash alternative. Oh, really? Even Davey Barstool is calling out Elon Musk. This guy, once again, has no loyalty whatsoever. He wants to pump up Tesla's stock price at any cost. Why is that, by the way? Perhaps here is an explanation. Tesla CEO Elon Musk qualifies for yet another $11 billion in stock options. Wait till Elon Musk exercises his options and dump on the heads of his culties. That will be the ultimate betrayal, and the culties deserve it. They deserve to get slaughtered by their cult leader. They haven't learned from Chamath. They need another, perhaps bigger lesson. You really think that Elon Musk will sit on tens of billions of dollars and he's not going to cash those because what? Because he cares about you? Think again. And that, by the way, leads us to corporate specific news. Starting, you guessed it, also Tesla, the souffle. The souffle is suffering a lot of problems here, and China is turning against Tesla, highlighting every accident, every problem to the population. Now, every car brand is involved in accidents, and perhaps the accident was due to a stupid driver, not the vehicle. But the Chinese media continues to highlight the problems and the accidents from Tesla for some reason, as if they are trying to engineer the public opinion against Tesla. But I know the culties and the Cathy Wood fans will say, oh, but Tesla's a monopoly, bro, and the competition will never catch up. Here is the competition from Ford. Ford plans to open a new global battery center in southeast Michigan, marking a step forward on its path to one day manufacturing its own battery cells. But Tesla's a monopoly, bro. Speaking of Tesla and Reverend Elon Musk, he's now in a feud with another space asshole, Jeff Bezos of Amazon. And you know what? If two space assholes want to go at it, beautiful. Pass the popcorn. And what about Boeing, aka the Flying Coffin? The Flying Coffin agreed to repay the U.S. government $10.7 million. After a 3-year investigation concluded, it double billed the U.S. government, the Pentagon, for taxes paid to foreign governments on overseas employees. You see, if you and I do this kind of practice, we will go to jail for a very long time. But for corporations, in this case the Flying Coffin, they get away with a slap on the wrist. $10 million, poof, it's gone, no problem anymore. And lastly, in corporate news, what about OnlyFans? Here it is. The future, bro. You want to talk about the future? Forget about Tesla. The future is OnlyFans. Because OnlyFans has boomed during the lockdown, and users spent $2.4 billion on the adult entertainment site in 2020, and 120 million people now use it. All of these Robinhood gains did not go to the moon, by the way. They ended up in the pockets of OnlyFans creators, shaking their booties and selling pictures of their feet. And by the way, OnlyFans is not listed in the stock market, so stop looking for the ticker. However, here's another indirect play for OnlyFans. You can buy Kimberly-Clark stock because the rise of OnlyFans also accelerated the use of Kleenex. Moving on to the heat map analysis. Let's see what's going on here with the market today, because the market was all over the place, choppy trading, earnings are impacting certain names, but all in all, the inflationary trade is outperforming. Financials, due to the rise of the 10-year Treasury yield, industrials, all in all outperforming, specifically for names like UPS, up over 10% today. Here is a name that has supportive fundamentals, supportive earnings, and also supportive macroeconomic outlook. Instead of chasing the garbage names, Palantir, Neo, Plug Power, Doge, Bitcoin, up 20% a day, down 20% the next day, what is the appeal of this kind of investment? Instead, buy names with solid fundamentals and solid earnings, in this case, UPS. But we also saw losses within the industrial sector, specifically for M. 3M reported decent earnings, but the name ran too hot ahead of the print. and therefore the disappointment. I own the stock in my portfolio and I see the dip worthy of buying because the supportive fundamentals, the supportive macro outlook, etc. We had Raytheon also reporting earnings and the name managed to climb higher. Energy, another sector of the inflationary trade, also outperforming, but lagging the rest of the inflationary trade is the materials sector. We saw declines for gold due to the rise of the 10-year Treasury yield. Likewise, we saw declines for the leader in the sector, Freeport-McMoRan, the ticker FCX, facing the resistance of 39. Bad day for healthcare across the board, with the exception of Moderna and certain biotech names. We also saw a mixed picture for the reopening trade, while casinos outperforming, Las Vegas Sands, MGM, Caesars, all closing with massive gains, along with hotels and apparel names. But the laggard here is the airline sector, not following the lead of casinos and apparel retail. Big cap technology muted for the day, awaiting earnings. Likewise, we saw the semiconductor names giving up some of the gains from yesterday's session. We cannot find a clear theme here for the market just from looking at the heat map, so perhaps we should do the themes analysis, and here it is, starting with the reopening trade. All in all, trading in the green with very few exceptions. And again, the names that are lagging, the names that have not recovered the pre-pandemic highs, in this case, for example, Cody, are outperforming. What about the inflationary trade? Also outperforming across the board, very few exceptions. What about the disinflationary trade? The contrast could not be any clearer. Specifically for the high multiple names, the likes of Square, Shopify, Peloton, Tesla, Nvidia, etc. And the pain will accelerate if Treasury yields start another impulsive rally higher. Speaking of, let's do the charts analysis, starting with the SPY 30 minutes chart. Nothing is going on today. Choppy trading, flat all in all, and for now, keeping the support of the very important level of 417.30. The SPY closing slightly above that level. What about the daily picture for the continuous contract of the SPY? Once again, grinding higher slightly every day, specifically under low volume. But there is a massive move coming. Could be up or down, but I am betting that it will be to the downside because the technicals are extremely extended. Furthermore, the majority of earnings are already priced in for the majority of names in the stock market. Actually, while the chart is trading higher, the RSI indicator is continuing on the negative divergence, which is a very important sign. What about the Qs? 30 minutes perspective. What's going on here? The Qs looking a little worse than the SPY. Still above the important support line of 340, but it is forming a bear flag formation. Now, the market will process the earnings we received after the bell today from Google and Microsoft. Google closing higher, Microsoft slightly lower. So the market will process these two and decide on the next move. But perhaps the market needs another confirmation. Should the market choose the way of Google higher or the way of Microsoft lower? The confirmation will come from Apple's earnings. Apple is the most important name to watch here. And if the Nasdaq decides to go the way of Google higher, then the dip in Microsoft will be worthy of buying. However, if the market decides to go Microsoft's way, then the pop in Google is worthy of fading. Remember, the name already ran really hot since the beginning of the year. Yes, the earnings are impressive, but again, adding another 4 to 5% after hours will be an opportunity to take profits. I see the market going back and forth once again until it receives Apple's earnings. That's the important one. What about the daily picture for the continuous contract of the Qs? Once again, negative divergence in the RSI, negative divergence in the MACD indicator. An imminent crossing to the downside is about to happen. Apple better change the course. But Apple itself is also extended heading into the print, therefore increasing the risk of a disappointment. The level of support here remains at 13,900. If the market closes below that level from a daily perspective, then we have a confirmation of a rejection, and the negative divergences will play out to the downside. We will see the Qs futures going all the way down to 13,599 or even lower, to 13,300. The risk versus reward here is not worth it, regardless of these impressive earnings so far. What about the IWM 30 minutes perspective? Once again, riding higher, but we saw a sell-off midday. You see this big reversal red candle, and that happened hand in hand when we saw the mania names, the retail crowd's favorite names, accelerating the losses. For now, it looks like the Russell 2000 has a short-term top. What about the daily picture for the RUT, the Russell 2000? We have 2,264. The chart has a confirmation trading above that level. So the bulls have the advantage now in the Russell 2000 from the daily chart picture. The ultimate test, however, is closing the week above that level. While daily closings are important, but the weekly closing will have the final say. What about the Dixie, the dollar index? The dollar is starting to bottom here. At least in the short term, you're seeing a saucer bottoming in the RSI indicator, signaling that perhaps the US dollar is about to pop higher. This is a very steep decline, and the pop from a steep decline, just like you saw with Bitcoin, will be a pop higher, a significant one. And a significant pop higher in the US dollar could come hand in hand with a sell-off in the stock market. And if we are reading the tea leaves correctly, if the dollar pops higher, perhaps copper has also topped for now, reaching almost to all-time highs and stopping there. Now, what are the implications on gold? We've been monitoring the chart of gold for a while now, and the correlation between gold and the US dollar is becoming less important when you compare it with the correlation, the inverse correlation that is, between gold and the 10-year Treasury yield. Today, yields are rising higher, and gold is trending lower, taking a pause. The technicals remain positive for gold, at least from a weekly picture. There is a bull flag formation, a positive divergence across all indicators, but if yields pop higher once again, I doubt that gold will be able to sustain the rally. So perhaps Papa Jerome can do the gold bugs a favor tomorrow by crushing yields. What about Bitcoin? What's going on here? The bounce from the oversold conditions and the 100 days moving average goes on for another day now. The ultimate test will be reclimbing and reclaiming the yellow trend line, which will be pretty much mission impossible. The bears still have the advantage when it comes to Bitcoin until and unless the bulls reclaim the trend line. Moving on to the 10-year Treasury yield, which is the most important chart of the day. Yields staging a massive rally today. Unnoticed, by the way, it was a stealth rally, yet it is technically significant. Yesterday, we talked about the mini bear flag formation versus the positive divergence in the RSI. I told you that we have conflicting information here. One of these two will play out by tomorrow, meaning today. And now we know that the positive divergence stands as the winner because yields went all the way, reclaiming the very important resistance level, now support of about 1.62%. Now, perhaps yields are rising higher in anticipation of the upcoming FOMC minutes tomorrow and the press conference with Chairman Jerome Powell right after. The market is saying that we will get a hint and more clarity regarding tapering, whether it is intentional or unintentional, by Jerome Powell. Perhaps one of the reporters will trap him into answering the question. Jerome has a difficult job of threading the needle extremely carefully, and if he is successful, then yields will retreat and this will be a one-day wonder. However, and this is, by the way, the likely scenario, because he cannot be vague for too long. The market will sense the upcoming tapering, and perhaps that will unleash another rally higher in yields. If that happens, forget about earnings, Apple, Microsoft, doesn't matter. The Nasdaq will get crushed, but specifically the mania names, the high multiple names. We already had one flush down in the mania names. For example, ARK Invest forming a massive bear flag, along with Tesla, for example, meaning that there is another flush down, another leg down to come. Perhaps the upcoming rally in yields, if Jerome Powell is not successful of preventing that rally, will start the next leg, the next flush down in these names. What about the TLT, Treasury bond prices? The opposite picture, reversing lower, and we are awaiting confirmation that the TLT has indeed turned bearish. That confirmation will come from the MACD indicator, a negative crossing creating red impressions in the histogram. What about the VIX? Once again, If Treasury yields are about to explode higher again, then the market will take a leg down. Perhaps financials can withstand the rise of Treasury yields, yet big cap technology names, forming pretty much over half of the market, will suffer, and that will ignite a rally in the VIX. The VIX has been consolidating candle after candle after candle, yet the momentum for the MACD indicator and the RSI suggesting that the breakout higher is imminent for the VIX. The risk versus reward says, while the VIX is consolidating, puts are still cheap. If you need to protect your portfolio by buying puts, this is indeed the time to do so. If the VIX pops higher and we start to panic once again, those puts will become expensive. What about Apple reporting tomorrow? The most important name, not doing anything at all, consolidating just below the resistance level of 135. The risk here is to the downside, even if the earnings are impressive. The earnings must be extremely impressive. A blowout number to allow and unlock another rally in Apple shares. Absent of that, we will see a disappointment. What about Tesla? Breaking the support level, the negative divergence in the RSI is still here, and we have an imminent crossing in the MACD indicator, signaling a loss of momentum. The most important take here is the weekly closing. You don't want to see Tesla closing below 679 from a weekly perspective. If you are bullish Tesla. If you are a bear on Tesla, of course you want to see it closing below 679 for the week, because doing so will confirm that next leg down, the flush down scenario, because we have a massive bear flag all in all from a weekly picture. We're waiting for that bear flag to play out to the downside. If yields rise higher tomorrow, perhaps that will be the initial stages for the next leg down in Tesla. Moving on to the conclusion of this video. What do we have in the economic calendar tomorrow? We've been talking about it throughout the video, the Fed minutes and the press conference from Jerome Powell. What about the earnings calendar? We have Boeing in the morning. UPS is an error. UPS reported today, but we have Ford, Apple, Facebook, and Qualcomm after the bell. We saw massive bearish bets against Ford, and I own the name, and therefore I'm buying those puts to protect my shares. Now, the contrast between Apple and Facebook will be very important. Are we going to see the same scenario we saw today between Microsoft and Google? Google trading higher, Microsoft down. Will we see Apple down, Facebook higher? Remember, the value name within the FANG or big cap technology names is Facebook. Tomorrow is the most important day of the week. Perhaps the most important day of the season. Number one, the Federal Reserve's decision or lack thereof. Number two, the earnings of Apple, the most important name in the stock market, which has been extremely boring the last few weeks. But I do believe starting tomorrow, we will see the market's decision and the action will heat up once again. Thank you for watching. That's all I got for you tonight, and I will talk to you again tomorrow.